Yo, what's up? This video is going to be about the basics of trading currency pairs. We currently looking at USD and JPY, which stands for United States dollar and Japanese yen. Now, if I was to go over to Japan right now, I would have to convert my US dollar into Japanese money. So, and this determines whether I'm going to be getting more or less for the US dollar, uh, in that particular time of the transaction, whether it's into a buy or whether it's into a sell, right? So, let's get into the candles. Um, I'm looking at a 15-minute chart right now. Now, every 15 minutes, a new candle is being created. This was the candle for 15 minutes, and then when that 15 minute passed, the new 15 minutes came up, and this is the new candle. All these candles is 15 minutes, right? Now, they move in pips, and your pips is how you able to determine whether you making more or making less, whether you making money or whether you losing money, right? And it's important to know this before you enter a trade, because you want to know how much you're risking, right, when you first go into it. So the foreign exchange market, Forex for short, generates like $1 trillion on a basis from Sunday to Friday. Now I believe it's like 7 trillion or whatnot, but versus the stock market is like a few billion, or it might even be like 7 billion or whatnot. Don't quote me on it, but the fact of the matter is that the foreign exchange market is on a larger scale, right? And they moving pips. So let's get into the pips. Okay, this is a JPY pair. This is how you able to count your pips. The two numbers that's after the decimal is how you able to determine. 38 would be 1 pip up. If it was 36, it'd be 1 pip down, right? So it's the two numbers that's after the decimal. So going back to the chart, see with the stock market, right? You buy a share or you buy shares, and you wait till it gains value and you sell it. That's how you make your money. And you want to pull it out before it crashes or there's a recession coming up. See, with the foreign exchange market, it's different. The foreign exchange market is recession proof because of the pips. And I'm able to, and I'm gonna show you why. Cause see, you could place your pips at however much money you want to, right? You can place it at $1. You can place it at 50 cents, 10 cents, $10, 50, $100, right? But it all depends on how much you have in your account, because we have a broker and it's all about leverage, right? You got to have enough money in your account to be able to bet $10 a pip. So for this example, we gonna place our pips at $1, whether it's going to a buy or a sell, right? So the green is when the market is into a buy, and the red is when the market is into a sell. So let's say I make a prediction. That it's about to go into a sell and hit this mark. This black horizontal line. But before I do that, let me explain the support and resistance lines, which is very essential when you wanna make some money in trade. See, these support and resistance lines is basically where the market will end up. It has a long history of hitting this line, coming down, testing this currency rate, and going back up. As you can see, this is the 15-minute chart. This right here is on the 12th of this month. It hit this line, and then it starts to come back up, right? It goes up, it tests this area, and then it comes back down. It comes right back down and hit this line, right? And this is between the 5th and the 6th. It hits the same as it did on the 12th. The same. It tested that same area and came back up. So this is another way or strategy how you're able to determine whether it's about to go into a buy or go into a sell. You know, once you get hip to these patterns, you know, you able to make an educated prediction whether whether to place the bet on a sell or a buy. And that's what it's all about. So that's all the black lines, this yellow line or whatnot, that's support and resistance, which is very essential. And you will learn much more about it once you get more technical with it and dive in, right? So, okay, but let's say I'm making a prediction that it's going into a sell and it's about to hit this black line right here, because what it usually does, it gets up in this area, it tests this area, right? And then it comes back down and hits this area. So I'm making a prediction that it's going to go into a sell and it's going to hit this line. Now, if I'm making an entry right now, it will be at this green line because that's currently where the market is. The market is closed right now. So, like I said, Sunday through Friday, when the market is closed, on Friday, whatever pair that you're dealing with, they all have their different times. So, at 5 o'clock, this one closes, right? So it stopped right here. So for example, say like I make my entry here, and it's at 0.38. Now let's get more into the introduction of pips. We looking at, again, a USD and a JPY. This is a JPY pair, and this is how you count it. The two numbers after the decimal is the pips. So this number right here, 37. If it was 38, that means it went up into a buy, 1 pip. If it's 36, that means it went into a sell, 1 pip. These are the pips. This is what we count. So back to the chart. Where the market is currently at is at 0.38. So if I made an entry here, and I'm making a prediction that it's going to go down and hit this black line. Okay. So now we are in profit. We in profit now. If it goes beyond this 0.38, beyond this line that I entered at, if it goes up here, that means it went the opposite of what we predicted. So we're gonna be losing money. But see, right now we in the profit. We in the profit right now because it's below our entry. And this is where I got my take profit at. This, once it hits this line, it's going to take me out of the trade and deposit however much, right? So let's do the math. 0.38 from here, 0.38 from here, all the way down here, which is 0.70, and you got to count the number that's before the decimal, right? So that's a total of 68 pips. So if we place in our pips at $1, that'd be $68 in my account. So okay, look, we making money. Now we in profit. We making money. Boom, it hit. Boom, 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 it hit. So since it hit my take profit, we out of the trade. I did the calculation from my entry all the way to this black horizontal line is 68 pips. We placed it at $1 a pip, which makes it $68. So it took us out of the trade, and now it deposits $68 in our account, right? So now, since it hit my support line, I'm getting the indication that it's going into the buy and that it's going to come back up and hit this line, right? So this horizontal line, well, no, let's not say that line. Let's say this line. Let's go short. Say, it's going into the buy. So now I'm making a prediction that it's about to hit this black line, which is at 0.07, right? 7.07. So my entry, I made my entry, which is right here. So now we in profit. Up. We was in negative for a little bit. Now we in profit. It's consolidating. It's consolidating. Don't know what it want to do. Okay, starting to go back. We're back in profit. Okay, there you go. We're making money. We're making money. We're back in the... Okay, it's going down now. Alright. Our take profit is here at this black line. Boom. When it hit that black line, we made money. We in profit. As soon as it hit. So, that's basically what it's about, right? We talk about gave you the PIP introduction, the support and resistant lines. Oh yeah. The dope thing about this as well is that, okay, when I made an entry that it was gonna go into the buy, right, to this line. When I made an entry that I made an entry about here, where the market was currently. I made a prediction that it was gonna hit this line. It was about to go back into the buy and it was about to go up. Now, instead of putting one entry at $1, I could have put 2 more entries at $1. So that would have been however many pips from here to here times 3 if I placed my take profit at the same spot. Or I could have placed them individually in small places. I could have broke it up. I could have made 3 entries at one time and put my take profit here, so when it hit, I deposit that. It retraces. It hits my second line, right? Deposit that, takes me out to trade, deposit that. I still got 1 more entry in, and I placed in my take profit here. It retraces, and then it goes back up. Boom. It hit my 3rd take profit because I made 3 entries total. So, for example, say I made 3 entries where the market was currently at this time. When the market was right here, right? That's when I first started to make my 3 entries. Now say I make my 3 entries there. I make a take profit here, right? And then I make another take profit here. And then I make my 3rd take profit here. Right? It's going up. Boom. There's my first take profit. Now I got 2 more entries in. I just deposit this money right here. However many pips this is, I deposit that money. So I already took care of my first take profit. My second, we made money. We out of the trade, right? We made money. And boom, our 3rd. You can make multiple entries and you can place your take profit wherever you think the market is about to hit, right? Now, the take profit is just as important as your stop loss, right? So when you place the take profit to where you think the market is about to hit, you want to place your stop loss as well, where you think, well, your stop loss is how much you're willing to risk, right? So let's go back one more time. The market is here, all right? So say I want to make my take profit. I want to only risk $10, right? So the market, this black line, well, no, let's go to according to the market. The market is at 0.74, right? So if we go on $1 a pip, let's say I only want to risk $10. I only want to risk $10. So I'm going to go 0.64. Boom. That's my stop loss, right? Now, if I make an entry here, if I make an entry there, and if this market hits this stop loss, then I'm out the trade. We lost money. That means we lost money. See? But see, it already hit my take profit, so we deposit that. That's money right there. As long as it don't hit this stop loss, then we still in the trade. It's about to hit the second take profit, and it's about to hit the third. So in this particular situation, it didn't hit your stop profit. I mean your stop loss at all, and you can place your stop profit however much you want to risk is where you want to stop, where you want to place your stop loss at. It's however much you want to risk. Now, this is something to take in consideration as well, right? Once you enter a trade, you want to place your take profit and your stop loss, because if you don't, or you want to place it at a position where you think it's going to hit before you zoom out or you stop watching it or whatnot. I mean, you can be a trader to where you watching it all day, like that particular trade or trades, like all day, or you can just come in, check it out, check out the history or whatnot, and be like, okay, it's about to hit here. I got the indication based on my indicators and all that it's about to hit here. Set your take profit, set your stop loss, and then boom, just leave it at that. You can go either way or both, whatever. But I'm trying to explain that. Say, for example, if we place an entry here, right? You place the entry, and you set your take profit here where this line is. So the market goes up, right? And then the highest it goes is right below your take profit. Comes down and then hits your stop loss. You lost money. So you want to keep in mind that you want to make the perfect take profit position. And another thing is that, say you make an entry here and you don't make any take profits. You don't set up a take profit position at all. You don't set it. And you made an entry here, say the market comes all the way up here, right? It comes all the way up here. You can put your stop loss just below it, just in case it decides to go into a sell when you predicted it to go into a buy. It's going to take you out of the trade, and all this here is your money. You made all this here, depending on however much you placed as your pips, the value of your pips. That's all profit. You want, if the market is going up, you want to move your stop loss up with it, because you don't want to lose money when you could have made money. And that was the perfect example. If you made an entry here, the market starts to come up, and then that's when it turns right below your take profit. It comes up, and then it slides right under your take profit, never hits it, and then comes all the way down to your stop loss, whether it's $15, $10, $20, $100, whatever. So that's what it is, yo. That's the basics of trading currency pairs, and we call it an educated prediction, because once you get hit to the tendencies, the trends, the patterns, you able to predict, where the market is about to go. You get hit to your line of resistance lines, your indicators, different strategies, what works for you. It's a lot of categories and field that you can go in. You can trade a lot of different ways. You got a lot of master traders that keep it real simple, and you got some traders that's more complicated or complex with their strategies. So for me particularly, this is the directional movement index, and this is basically the momentum of what's going on in the market. For me personally, if this green line, which is the momentum for both sales and buyers, if it's not about to go above this black horizontal line, which is the 40, if it's not about to go above it, then I usually don't, more than likely I'm not about to enter that trade. That's just how I trade. That's how, that's what works for me, So this is, like I said, this is the indicator. And as soon as you get in and learn the terminology of it, you know, coming in and looking at it, it looks foreign or whatnot. But like I said, when you learn the terminology of it and what certain things really mean and what they do, you realize that it's really simple, right? So that's what it is, yo. Hit me up.